Hey everyone, welcome back to another episode. Today we're talking about Oracle, the company that just had its stock price spike by I think like 40% in the last couple of days. Let's go over what I think of Oracle and whether or not this company is a buy, hold, or sell right now. So the headwinds and tailwinds for Oracle really, you have a high amount of competition, and you get to see that they do have a high amount of capex, especially from the free cash flow standpoint, where there's basically nothing going on here. They have no free cash flow for the last year. But tailwinds, as everyone knows, right, they're massive demand for AI. They have great cloud, which will increase their margins, and they also have really high switching costs. So if once you're in that ecosystem, it's hard to get out of that ecosystem, which is a good thing for Oracle. So let's put it together. I know I can go. I'm going to go fast with this because I know I want to get this episode out, and so I'm not going to go into super more detail about any of the things I'm talking about. But let's get into the margins and profit, right, or revenue and earnings. So the 10-year growth, 9%, 11% for 5-year CAGR, with earnings all over the place. I mean, this is not bad, but doesn't really justify that massive spike, right? That massive spike hasn't actually gotten fed into Oracle shit as the markets are forward looking. So what am I seeing from Oracle, right? Because of they did, well, this is the margin side, right? That I'm always going to cover. Currently they're at 21%. Could they get up to the 30% they used to be at? Possibly, but know. I don't know if I actually believe that. I think a more reasonable idea would just be to have it at 21%. 10-year median, all of this that is reasonable. So I'm not just going to speed on to the next slide. I'm going to say that they can get a 45% growth, year-on-year growth in revenue for the next 5 years due to the backlog that everyone's seeing. Right, 300% growth in that backlog is amazing. 21% profit margin, basically what they're at now, and sustained PE right now gives an intrinsic price of 348.52, which is a bit about where they're at right now. But once we go to the free cash flow, we do see something change by a lot. We see that in the last 5 years, they basically lost all their free cash flow. They quite literally spent everything in deploying, making the cloud. So what am I saying here, right? For the future, I do think that if we do assume that they start off at a higher point and you are able to grow at 50%, right? Because of their increased earnings, I do think that they would be able to get this intrinsic price up to about $265. However, that is so low simply because they do have almost a tenth of that uh, costing of debt, right? So that's always going to be something that takes the company down a little bit. Um, Dividend wise, they've had an 2.75% growth rate. If that continues and sustaining this in yield, that gives you an intrinsic price of about 372. Not really much more to say here. The company itself, right? You guys can go through all this, and really, overall, I think it's probably around $300 is a pretty fair price for it, which is exactly where it is, essentially where it is in line right now. Target probably next year of 345, about a 15% increase. I think that all that is reasonable. So right now, my opinion on the company is that it's just a hold.